I think 2026 is likely going to be the most exciting year we've seen so far for like Solana Perps. I think there's generally like a appetite for trading that we've seen from Hyperliquid users we haven't seen replicated on any other chain yet. One of the other exciting things is a lot of like kind of the RWA products we'll see, which are like, they're actually not exciting, actually really boring products, but like they're really like, there's like true actual innovation happening over there.
This episode is brought to you by Sablier, the leading on-chain solution for token distribution. You'll hear more about them later on in today's episode. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. Hey guys, welcome back to another episode of Lightspeed, a very special holiday Christmas Eve recording with my good friends Teddy Osterbon and Ian Unsworth of Kairos Research. Glad to have you guys on. A little bit of a peculiar timing, but we needed to get this episode recorded before the holidays really kicked off. So Ian, a little upset with your timing today, a little bit late, but I'm hoping you can make up for it today with some great answers. How are you guys doing today?
Doing pretty good. I apologize for not being punctual.
It's pretty nice being able to talk to you without having Boccaccio in the middle too. I'd say that's a big difference.
Yeah, different experience. I feel like Bach, he's a bit of an instigator at times. He always wants to start something.
Yeah, I like his format. It's fun. I feel like he's becoming more and more confrontational on the pod, which is nice. But yeah, he's also just so funny. So, but nice to see you're manning Lightspeed. You're doing really well.
Appreciate it. Love it. Well, I'm glad I can get you guys on. I think it's pretty topical, like what you guys do with Kairos Research, at least relative to maybe some things you can speak on the Solana side of things. I wanted to maybe jump into that, like what you guys do at Kairos and some of the developments we've seen on like the Solana kind of client and validator software side. Like, I think we went from a very much like you were just sort of running, like pretty much every validator out there was on Jito and Onza software for a long time. But now there's, you've got Firedancer coming into the mix. There's Jito BAM. Harmonic is pretty new to the fold. And then there's like 00 as well, which isn't like necessarily in direct competition with those other clients, but still like another kind of additional piece of software you might run as a validator. Like, I guess maybe you can talk to us a little bit about like being an operator and like your views on the landscape and like what makes sense to run today. Like where are the trade-offs? Does it make sense to just like always be on the newest and greatest, maybe due to some of the incentives they offer, or how are you guys thinking about kind of the landscape?
Yeah, I can take that one. So I guess like kind of quick background context on Kairos. So we're like a small research shop. We do research on anything that intersects around like market dynamics and protocol mechanics. So a lot of our research is around DeFi, and then that kind of naturally stemmed into kind of base layer network operations as well. So that's how we actually got started running like a Solana validator. Late last year, we kind of made that decision. We wanted to, get into the validator space. And now we're on Solana, Fogo, Babylon, Celestia, and Monad as well. And so I guess like kind of when looking at the validator landscape, we joined relatively late in the game. But this kind of helped us be very critical about all of our decisions about, actually becoming competitive on the Solana network, which is pretty difficult today, just given it's the most competitive validator landscape by nature of just being the most used chain out there. So we've experimented with various client software, like, when we first joined, we were just running vanilla Agave, then we went to like Jito Agave, and then we ran Frankendancer with Jito. And then we are now running Jito BAM. So we've seen a lot of like different variations. And a lot of the time it's just trying to optimize for our own stake, which is, I think, what most validators are doing. Right now, there's small differences between client software out there, but there's not large differences. And I think that's just because the network is relatively distributed, I guess. Like there's not too much to actually separate what is going to be able to be handled. Like even when you saw like the Fire Answer native client actually take place now, it's like the thing it's best at is just voting extremely fast. And it really just comes down to like how many transactions are going to be in that next block that it has the chance to produce. So like there's not too many differences across like the validator landscape right now. Like they're marginal, but do expect that to kind of change with the Jito BAM taking off, and that's going to kind of allow for some unique block building, I guess, with all the plugins and Ace and all that. And then also, like you mentioned, Danny, Harmonic is now coming on the scene. We track all of these pretty closely. I noticed that Harmonic was a small group of validators initially. A lot of those just run by the Temporal team. But actually looks like 2 of Coinbase's validators are now running Harmonic, which I think is an interesting call out. And then on the Jito BAM side, that's up to 128 validators now. So I think roughly 9% of network stake. But yeah, that's a kind of a long-winded answer, but yeah.
Yeah, I think great overview. I guess I want to ask, like, if the differences between the clients are relatively small, like it would seem to me that the incentives, like the staking, or the stake provided as incentives by some of these different teams. Like I'm pretty sure 00 has a program. I think even Jito BAM has a new offering that they're doing for a certain time period. Obviously the Solana Foundation for a long time incentivized validators with stake. I would imagine that must be a big decision-making kind of part of the process today if the other differences are pretty small. Would you agree? Like if you, let's say with or without incentives today, like how impactful would that be to your business?
Definitely vary. And I think you're kind of seeing that across the entire landscape. Like the Solana Foundation has started walking back some of its like delegation programs that they had. And they're kind of scaling that back, and they're kind of ripping off the Band-Aid, and we're starting to find the natural network equilibrium of like, this is how much it costs to run a validator. This is, how many validators are actually going to be on the network. This is how much stake you need, and all these kind of natural things. So I think it was an inevitable thing, but we're always going to see a shift towards stake pools actually controlling the network. Like I think these are going to have a massive sway, and you're seeing that right now between like Jito Sol is like the largest stake pool. 00 is very close as well, and a lot of that stake that 00 has comes from the Solana Foundation. And I think every single validator on the network that's not like an institution very much is optimizing across these programs and other smaller stake pools as well, just to try to like get as much stake as possible. But yeah, I mean, if you look at the validator count in the network when we joined, it was around 1,200. I think today it's around 800. So there's a lot of validators dropping every single day. And again, I think that's just kind of naturally what's going to happen on Solana. I think like most institutions will operate their own validators. It's becoming, I wouldn't say commoditized, but a lot more common for that to be the case. Like Forward Industries, like they have their own validator. A lot of the DATs, it's the same thing with them. So that's just kind of the natural progression I see.
Gotcha. And I guess if you're one of those larger players, you just need to hire, an Ian Unsworth to come and operate your validator, and you're good to go. And if you've got 20 million, active users that are going to drop some SOL into the account, then it's kind of like pennies. And they tend to take a higher take rate on the inflation as well. So it's sort of probably higher margins for them as well, beyond your typical like on-chain kind of DeFi native operator.
Yeah, for sure. And a lot of the larger ones can also operate at scale in a way that smaller ones can't. We went at 0.0 commission a bit just to get into the Judo Sol stake pool. Just because like that's one of the requirements is like, they want to be able to pass on as much stake to, people that hold Judo Sol as possible. But when you look at like the top 10, 20 validators on the network, a lot of them are at 0.0. Helios, I think, was kind of first to this trend. Because if you go 0.0, you get more stake. The more stake you get, the more blocks you build. The more blocks you build, the more leader like slot rewards you get. So it's just kind of a natural thing. And we're also seeing like Bitwise's validator, like they do that as well. And so yeah, I think that's like another kind of trend you'll see going forward. But again, like that's just one of the kind of weird economic incentives for all proof of stake networks. So I think it would play out like that for anywhere if they had this style. And I think it just kind of, likely accelerates over time. But yeah, you're totally right.
And maybe just to kind of round it out, so you operate on a couple different networks. So you mentioned Fogo, Monad, a few others. Like, is it relatively similar? Maybe not to the maturity of the network, but in terms of the operation of being a validator operator on these different networks, is it a similar playbook where those foundations are incentivizing stake to validators to kind of hop in and join the ecosystem, or how does that look across the fold?
Yeah, that's the natural thing. And so I think that's also why if you pull up like any proof of stake network, for the most part, the charts kind of all look the same. There's a couple outliers, but a lot of the times it's just like, networks overpaying for inflation. And this results in, validators dumping tokens because it's what you're incentivized to do, because you're essentially getting more money than you need because it doesn't cost that much to run these validators. So there are some like unique validators that really push the network forward. Like I think Solana's probably got the most unique validator set where there are a lot of smaller early validators that have contributed in like an outsized way to the network, because there's more, I would say, like opportunity for customization on your validator, whereas that's not really the case for a lot of other networks. So it's very is much like commoditized on other networks. And yeah, that's just kind of what you see happen over there.
And maybe one last, so I think you mentioned TIA as well, which I think is an interesting one. So like in my mind, I would almost wonder if it remains kind of like net positive to operate for the TIA network, considering just how significantly the token is drawn down, or is as long as the inflation rewards are meaningful enough, like it can still make sense to operate a validator there? Or is there some like known kind of like drop off point where you'd expect, participants to start falling out there? Because I mean, that chart has been a down only thing for a long time.
For sure. Yeah. So, I mean, as long as your inflation rewards are greater than your inflation plus like commission rewards are greater than like what it costs to actually run the validator, plus like all other operations that you're paying for on your team, which I think varies a lot. So like anytime a network wants to decrease inflation, they go to the governance forum, they put it down, and then, a bunch of teams pop up saying like, you can't do this. It's gonna like, cost us like this is gonna hurt our business. And it's like, okay, well, like a lot of these businesses are just predicated upon like fake money falling out of the sky. And so it's like you need to rip the Band-Aid off in a lot of these networks. And that's honestly why we joined. Like we just saw it as like, here's a way to like get more involved on the networks itself. Like, and we have a much better understanding of the base layer economics of a lot of these networks, and we have more skin in the game. But the other side of it is just like, purely financial. And I think that's the case for a lot of these operators out there as well. Like I don't think too many people would do this as a charity.
Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axie Infinity. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at Sablier.com.
As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
Yeah, I think that makes a lot of sense. And maybe relevant to Solana as well. I think you guys have been positive towards inflation reduction proposals for TIA, but I know that similar ideas, and there's a newer proposal going out for reducing the Solana inflation rate on like an accelerated timeline. I guess similarly, is that something that you are in favor of, or do the current dynamics like play to your favor still?
I mean, they play to our favor, but we've always voted yes for any inflation reduction across any chain we support. Like when SIMD 228 was around, we voted in favor of that. We want to see inflation reduced. And then also like new networks that we're involved with, like Fogo, we gave some recommendations to the foundation over there for what the inflation schedule should look like. And we had a pretty aggressive schedule of starting at 6, tapering down to a terminal rate of 2% within 3 years, which is extremely aggressive compared to like the 15-year schedule that Solana is on to get to its terminal rate of, I believe, 2% as well, or it might be 1.5. But I'll double check on that. But regardless, and then Fogo, ultimately just decided to start at 2% instead and just stay at 2%, which I think is just like a healthy decision. Hyperliquid as well has very low inflation. I think any like chain that's very serious about themselves should not be handing out free tokens. The like security as a meme is very much a real thing. We've never seen a network be successfully economically attacked. Even when Luna was blowing up, that was probably the biggest chance to attack a network, just given it was so cheap, and people tried and they still didn't even succeed. So I think that's probably not something to over-index on when you're thinking about where your token distribution should be, because ultimately your token's incredibly important. That's your primary incentive mechanism for directing all activity on the chain.
And do you think, to that point about the economic security being immune, I know Totally loves to say this as well, but do you think this is people indexing to that idea, or indexing to the idea of we want to have 400 validators, 500 validators, because that's a number we can sell, in marketing materials, versus if we only have 50 but they're hyper competitive, it's not as interesting when we then get compared to Solana or Ethereum or Bitcoin. The number looks small.
Yeah, I think some of it was just hangover from first, I guess, a lot of ideology stemmed from Bitcoin, and then it goes to Ethereum, and then it goes to every other network. So I think the Solana people just never wanted to be pointed at by the .eths and them laughing and saying you're not decentralized, blah, blah, blah. So it's okay, well, let's have a bunch of validators. And that worked well. But I think also now we're realizing that you don't actually need that many. And they can be geographically distributed, and obviously double zeros can help out with making sure that you don't compromise on performance for geographically distributed validators, which ultimately I do think is a good thing. But raw number of validators being a metric that should be important to your network is probably largely a psyop. I don't think there's a perfect number for any network really, even Ethereum. It doesn't really, I don't think that's a core idea. I think there was more anyone should be able to do it. And I think it was a lot cheaper at the early days in Ethereum. That's kind of why that ideology, I think, then stemmed out. And then you have other networks like Monad, Monad's, delegation program incentivized geographically distributed validators. So on testnet, we were in Australia. Now we're in North America for mainnet. And they're still cranking out 400 millisecond blocks, which is, right in line with Solana's performance. But yeah, I think these are the kind of things it's important not to over-index on.
Yeah, I think that makes a lot of sense. I guess if you could look forward to a world where even if there's, multiple concurrent proposers and they're kind of distributed around the world on a maybe you actually only have, one node that's sort of like at each major city or country around the world. And therefore maybe there's only like 200 validators or so. Or maybe you have a few kind of like individuals competing for that slot in that nation or city. It looks quite a bit different than having like, 2000 nodes, but effectively the performance might be the same or better.
Yeah, like MCL is very much like the antidote to that as well. Like if you can take away the monopoly of any one validator having, oversight on producing any block at any given time, I think that like kind of just generally levels the playing field, and kind of cuts through a lot of the worries and edge cases that the armchair generals like to point out on Twitter. But yeah.
Yeah, I think that makes sense. We've seen a lot of ideologies have remained firm, but a lot of the like action taken has definitely shifted in a particular direction. Like I think the Ethereum everyone should be able to run it on a Raspberry Pi idea is like slowly falling out of favor there. And like you're saying, like we're seeing on Solana certainly as well, like there's been some reduction in the amount of nodes. There's been reduction in the amount of like incentives to just have a consistently high number of like, maybe they're just sort of like redundant, incentive farmers, so to speak. So we're definitely headed in a certain direction there. So it'll be interesting to see kind of how that continues to evolve. Maybe getting outside of the actual validation piece. I mean, you guys invest, trade, you keep up with stuff happening in DeFi. I guess, do you have any core ideas going into like 2026? Are there particular sectors or tokens or just themes that you are like really attracted to, or keeping an eye on going into the next year?
Yeah, I feel like the end of this year has been kind of slow, and a lot of people have been a little bit depressed in a number of ways, being like, okay, like what apps have been built that we're proud of and that we can say have staying power and that feel like they've made a difference. And I feel like that has been a bit lacking. Now, I think that there have been some apps that actually do have staying power built this year. Whether it's ones that we need to be proud of, I'm not sure. But I think Pump Fun has had staying power. Like I'll be eating dinner with friends who don't work in crypto and aren't in crypto, and they'll like have a Pump Fun browser pull up on their phone and just like laugh at it and like occasionally buy something on there. And then I think with Hyperliquid too, like it has been something that like these crypto exchanges have obviously been the most profitable business within the industry for a number of years, like Binance and Coinbase, et cetera. So I think we have built an app that actually can make money and does have staying power. I think with Lighter and other exchanges, we're going to see creativity around fees compress how much money you can make in that game. And it will be interesting. Like, obviously, there's enough money within crypto and enough volume within like people just speculating on Bitcoin and other crypto assets to keep that profitable. But I wonder exactly what happens next. Like, it does seem like there hasn't been quite as much interest in speculating on crypto assets that haven't produced meaningful value.
I'm curious. I want to ask you as a follow up there on Pump. I want to say we had you on, not this podcast, but maybe Xerox Research probably several months ago now. And I think you were pretty bullish on Pump at the time. Obviously the token has not performed very well. People on the timeline are asking, is the activity fake? Who knows? Maybe some of it is, maybe the token creators are incentivized in some degree. Like we saw a bit of a rotation from Pump to Bunk or Let's Bunk for like a month, a very explicit and very jagged month. So maybe there's some incentivization that happens behind the scenes that we don't see. Hard to say, but I'm curious what you think about like their defensibility, like the moat of their platform. Obviously they're very like meme centric, and meme coins have not been a very high activity asset now, like on the back half of this year since, early 25, late 24. We've seen more excitement around like perps, like you mentioned, some of the platforms and yet platforms like Phantom and wallets and some of these like trading front ends that maybe don't necessarily index to like an asset class, but just are looking to offer kind of all varieties, and then people will go there and trade, and it doesn't matter if it's stocks or meme coins or perps. They still capture flow regardless of kind of the current regime. Do you think Pump needs to like expand their like viewpoint there and build a perps product like within the mobile app, or is there room for like meme coins to kind of propel them higher, going into next year? Maybe we're just in a slump.
Yeah, I mean, I think speculation will always come back. I think that Pump kind of outsized the supply of these meme coins and made it too easy to make them. And when there wasn't an inflow of demand and attention, like obviously people just kept making more tokens and being happier selling them at a lower price. And I feel like that has spiraled down to now you don't see many tokens go above $1 million market cap when it used to be several billion, which then I think makes the whole platform less interesting, and meme coins a little bit less interesting as well. But yeah, it's a good question. I wonder, like, maybe what is it that it takes to get people just interested in being on chain, and maybe that brings flows into other forms of speculation again too, like meme coins. Pump is a tough one, like you said. Like, we don't know what amount of the volume is real and what amount of the profits are real, and like, I guess I don't have a reason to believe that they're fake, but there also hasn't been any communication from the team. Nobody really understands if that like nearly $2 billion raise they did was that an investment into the business, or was that just buying the tokens from the founders? Like, I don't think anyone knows like whose money that is now. Is that like, can the founders just cash that out, or is like that going to be used to build the business? Like, if that's being cashed out and all of the profits are going to buy back Pump, like, what else can they build out? But then they made an acquisition too. So like, again, it's all confusing. I don't think there's been a lot of communication there. I think you could make the argument that it would be silly to own Pump and sleep at night well. Now I've been buying a little bit. But I really understand like why people are uncomfortable with it and why the token versus equity rights conversation has been happening. And like, we saw another acquisition within space by Circle recently where token holders were completely wiped out. And I was like, okay, so you use token holders as a way to generate marketing speculation, raise capital, and then as soon as you want, you can just walk away from them. It's interesting. I think it's obviously an issue that makes crypto businesses less interesting to invest in from like a token holder standpoint until it's fixed. And is Meta DAO the way to do it? I don't know. I think that there's definitely some improvements there, but they're probably a ways off too. Like, I think it's a very cool concept. But
yeah, I guess if you had $2 billion in the on-chain treasury, it'd be more defensible than $2 billion somewhere. Somebody's got it. Maybe the follow-up thought is like, if you're Pump, like what do you think is the right path forward? Like, let's say you're operating the business and your goal is not to walk away with $2 billion and rug the thing. Like, what do you do from here? Is it you need more acquisitions? You build out like more of a platform? Like, you kind of go the like look a little bit more like a Phantom or like a Robinhood and like add more horizontal offerings or verticalized offerings, whatever that looks like. Or do you lean in even heavier to like speculation first, all memes, new takes on meme trading?
yeah, I'd be curious to hear what you think.
Yeah, like there is like an interesting part of their user base which has not churned, and it is mysterious. We don't know why that is, and like if it's real or not. Like, we do get the occasional like random DM of like, hey, I'm launching this like shitter on Pump, and it's like, okay, like someone is still out here using this. But Yeah, I mean, I'm not entirely sure. Like, it is also interesting with their on-chain activity. Like, they did have like $1 billion of USDC sitting in their treasury, or I don't really know if you can call it treasury. It's like a multi-sig associated with the pump fund entity on Arkham, and that's now down to around like 400 million since like roughly mid-November. So, I mean, I'd be curious why they're sending $600 million to Kraken. Like, are they, are they going to announce an acquisition? Are they using this to fund operations? It's not entirely clear. Like, again, to like Teddy's point, like there's just such like a lack of understanding and comms from the team, which has always been like a issue for them. Like, there was like a kind of supposed to be like, I guess, like a communications channel for them, and I don't think that's taken off yet. And so like their biggest strength, honestly, outside of any product focused things, could just be like, tell us what you're thinking. Otherwise, we're just gonna try to sit here and like look through our crystal ball and guess like what they actually are doing. But I mean, there's a team there. They're very competent, obviously. Like, they've built a multi-million-dollar revenue product, which is incredibly hard to do. Like, they're clearly not idiots. Like, just tell us what you're doing, and I think like the market would reward that immediately. I don't think it can be too bearish at this point either. Like, I don't know. Like, the only things that we can really know is like what we see on chain, and what we've seen on chain with them is like they are using like 100% revenue to buy back their token. They own about 15% of the circulating supply. They spent over $200 million doing this. So we'd like to hope that whatever the ambitions of the team are greater than whatever they've spent this amount of buybacks on. Like, hopefully there's a product out there that's going to continue to help this. I think the one that was rumored for a long time was like Axiom acquisition, but I don't entirely know if that was ever really legit or if it was just people like kind of connecting dots and trying to like read the tea leaves. But yeah, my Christmas wish is the Pump Fund team tells us what they want to do and what they're going to do, and people can appropriately price that.
Yeah, I think that's fair. I do think Axiom rumors were probably a bit overexcited. I want to say that at the time, like an Axiom acquisition probably would have cost them a bit too much, given I think they were kind of operating at relatively similar run rates on the revenue side. I think that's maybe a little bit different today. But and they acquired Padre, like a sort of similar product offering in the time since. I guess, yeah, to your point, communication, probably a big piece there. I do think there's probably still plenty of opportunity for them to like expand this product into more of a platform. I do think the other big question mark, like outside of just what are they thinking is, whether or not you believe that there'll always be speculation. It doesn't necessarily mean that, meme coin trading is going to go to new highs next year. It might never go to new highs again, or it might take a few years and before it kind of sees a silly speculation boom like last time. So maybe they need to expand. Maybe they do need to offer perps. Maybe they need to offer prediction markets, XYZ other thing, right? There's lots of money that could be made if they've got organic users that have not churned from the platform that they can monetize. So, and we've seen, like the Axioms and the Phantoms and the Rabbies, like they're all leaning into this. Coinbase as well. They're all just looking to offer as many of these products as possible because they see the monetization opportunities, and they have existing users that they think they can convert some portion of. So probably would make sense for Pump as well to kind of expand their horizons, especially with so much cash, if they're assuming they're willing to use it for those purposes.
Streaming. Yeah, I don't know. I think again the lack of messaging and I think the lack of like mission around streaming was interesting too. They're like, there's this thing streaming, it's big, and we could do it. I was like, yeah, maybe there's some overlap where it was kind of funny to have people that were buying these tokens also be streaming. Like, there's a big world where people go to casinos and stream themselves playing table games. And I think there is significant eyes on that. So maybe there is a thesis behind it, but it was never like really well talked about or executed on. So it's all been just kind of funny back and forth. Like they announce something and then they disappear for 5 months and then announce something. And it's just tough to do that after you'd raised a couple $1 billion. But
yeah, I think they get this level of scrutiny being or having been one of the kind of the largest raises, one of the most sort of valuable projects. That's kind of the spotlight gets put on you in that way. I think, we sort of see the same for projects like Hyperliquid, for example, right? They're constantly put into question, our team, is the team selling just because it becomes like the darling or like the top kind of performer of the asset class. And then people start asking a lot of questions when that becomes not the case for a time period. So I think it's sort of natural to expect that would happen with Pump, given just how massive their raise was and how limited their comps have been since then. We can shift away from that, though. I guess maybe it would be interesting to talk about. We could talk. We mentioned perps a little bit. There is a little bit of this, like, Hyperliquid versus now Lighter coming into the fold and potential TGE coming up here soon. A lot of question marks and like combativeness over, Hype has the one true model. They put all the money in the token versus, Lighter, zero fees. It's fake wash volume. I don't know. Do you guys have a strong view here? Are you expressing a view in any way going into a Lighter token, or are you hype individuals, or kind of on the sidelines here?
I think generally I'm Hyperliquid biased. I think if you were going to build like a perps DEX as well, you probably want to do it as a standalone chain. I think that's probably the best way to do it, and I think that's why they've succeeded as they have. I think the team has been I think Jeff has just been like a pretty good communicator since the start as well. Like I think he also just kind of instills trust in people in terms of Lighter. Like I do believe it's like zero fees in their front end, and then they charge fees for API access. So I don't really have like any informed opinion on like their volume and whether it's real or not. I think generally speaking, a lot of volume in crypto is fake. And people are always paying to get volume on exchanges. And I'm sure like a portion of the Hyperliquid volume is quote unquote fake. I don't think volume itself is like a very high signal metric. I think obviously like Hyperliquid took a big hit in terms of open interest on 1010, as most venues did. And then we'll see, I guess, like, how much momentum Lighter is able to carry through after their token launch. I think that's kind of the ultimate test right now, because I think a lot of people were just kind of farming it as like, look how successful Hyperliquid was. But then again, like I'm not like, actually using Lighter, so I really don't have like a really super informed opinion on the product itself either.
Yeah, I tend to think that fee compression will be real, and especially with perps too. Like, let's say you're paying 10 bips on volume, but you're using 10 times leverage. All of a sudden, the fees start to add up, and you can actually see them. And retail traders will be, I think, slightly more cognizant of that than they are when they're trading spot. Just because it starts to seem meaningful in a dollar amount when they see that number. They're like, okay, well, if I could get it cheaper somewhere else, maybe I'm interested. Meanwhile, like retail traders on Coinbase have been using like the swap function, paying like 300 basis points for a year. So I could be wrong there. But I do think there will be some amount of fee compression that naturally happens. Like when anyone can make too much money from an exchange, like of course there will be a competitor that will want to enter the space. So I think that's what we'll see. And I think that the Lighter idea, I believe that is their concept, is they just introduce some latency to the retail traders. So it's kind of like a payment for order flow where the market makers can front run them and make money that way, rather than having higher fees. Like, is that the model that they still have? I believe that's kind of what I have heard. And it's interesting. Like, I mean, we've seen with Robinhood, something like that, like, ends up being lower fees than like having a 10, 15 basis point just fee per trade, because it gets so competitive on the market maker side, who are happy scraping a few bips here and there. But I think it's interesting. I'm also probably biased towards Hyperliquid just because they've executed very well. I'd like to hear your guys' thoughts kind of on the buyback model and using all kind of cash flow to buy back the token. I think in crypto, like, obviously a good token is good marketing, but there probably is a lot of things you could use that money for as well. So I want to hear kind of what you guys think of, like, is this the right decision in a growth stage? Have we figured that out yet?
Yeah, I'll happily jump in here. I think I've been interested to hear more people express this view. I think if you told people, hey, don't ship all the money into the token earlier in this year, they would say, shut the hell up, man. The hype token is incredible. It's up only. It's outperforming everything else in the space. And you go, well, okay, I won't say anything else. I think I've personally had a view for a while that I don't know why so many teams, I think it's just like the experience of the past of what has come and gone in crypto, but like so many teams are still so anchored to this idea of like needing to decentralize things right away, needing to decentralize decision-making processes, needing to decentralize the protocol. And I just think that is such a mistake so early on into any of these projects' life cycle, especially for hype. I guess I've been mostly surprised. Like, I'm not going to say that they're bad executors or, like, you know, operators. Like, I think it's quite clear that like Jeff and team are quite good at what they do, but it's surprising and maybe disappointing that they haven't just expanded their team and taken on more rather than what they have done, which is like, okay, we'll build a way for the community to build stuff on top, which I don't think there's anything wrong with doing that, but it would also be great. Like, if you're such great operators, you could do more of it yourself. You could hire 3 more people and then they could execute it in a very specific way. And maybe that would be more successful than all the effort that happens on the community side, especially with how much money you're making. Now you're shipping it all into the token, but you don't have to. So I think for me, that's like, I don't know, if you looked at a typical like growth tech company, they're not just like shoving all the money into the stock year one, like, or like pre-IPO or like 1 year post-IPO. It's like, okay, let's hire a bunch of people. Let's like expand, let's grow, let's do a bunch of efforts, see what sticks, find more PMF, expand. And I just think we have a continued like failure to do that in crypto specifically.
I think this might not be a novel thought at all, but airdrops seem to be one of the largest things that have limited innovation within crypto, because it's so easy to attract users by promising an airdrop, and then you have a token out there in existence, and as soon as you have like a tradable token, then that becomes too big of a concern to actually like build out your product base. And then all of a sudden securities regulations come into play. You can't say, hey, listen, we're making money, like our revenue is growing quite a bit. At some point in the future, you're going to have access to this. You can't promise it to them. You can't really do anything. So then people are like, they're making money and they're not giving it to the token. Like, what happens now? And so then they move on to the next one that has an airdrop, and maybe that protocol like buys the token back. So like, I think you're trapped between a rock and a hard place, because one team can airdrop it and avoid securities regulations and somehow accrue value to the token. And the other one, like, no matter how honestly they try to build, and like if their plans are to deliver that value to the token holders at some point in the future, like they don't know that they'll be able to do that. And the token holders don't know that they'll be able to do that. So it just seems to be like, again, I don't know if this is novel at all, but it seems like airdrops have now somehow played away and like not letting our industry grow to maybe what it could.
Yeah, I think like airdrops, I guess, can help incentivize network like product adoption at first. And then, the funniest thing with buybacks to me is always just like when the market's hot, everyone's like, yeah, like keep doing the buybacks. Like this is a good idea. And then like the market kind of cools down. It's like, you idiot, dude, stop buying back your token. This is so dumb. And like, there's not really any in between. And I do think it's kind of like to Teddy's point of like, there's not clear expectations for token holders. Like we have no idea what like kind of legal rights token holders actually have. And the best way to like show alignment is just to actually take all the money and put it back into the token for the most part. It's just kind of weird. Like you're seeing, I guess, all the ways it could go wrong now, like unfolding with like all the Aave drama. So I mean, it's just kind of like a weird setup in general. But yeah.
Yeah, I mean, there's definitely a lot of path dependency here that probably impacts what the best decision at the time is. But maybe to your point around, everyone says the buybacks are great at the top and they're awful at the bottom. It's actually interesting because I think the inverse thinking is the correct one, right? Like they should arguably not be buying the token when it's, potentially way overvalued in the short term and using that money for growth. And then maybe in a period like now, it actually does make sense to buy the token if you think the longer term prospects look quite good relative to the value. It's probably still a question mark in terms of like whether that money's better spent for growth anyway. But I think in this industry, it's just kind of given the path we've been on, at least to some extent. Yeah, I mean, you're gonna eat a penalty for not like putting some money into the token today, like not showing some form of value accrual. And so like I agree to an extent. Like it doesn't really make sense to go zero buyback model today, just because you're going to be penalized so hard for it, and
Also,
maybe
like,
even lose users.
Yeah, maybe it's the burden of making money. If you're like a random like infrastructure coin, it's like, okay, we can just kind of trade this purely off narrative. We can just like say we're doing all this stuff because like there's no money to buy back the token with, and that's the case for like a lot of protocols out there today. Is like there's a lot of ideas, but there's not a lot of like products. Like there's a lot of like real vaporware out there that makes no money, shouldn't be valued where it's valued at. And I think we're probably going to see over like the next couple of years, a lot of these just like vanish. And then some projects that make like very minimal revenue, trying to signal like they're a real project by doing buybacks, where it's like, okay, this is just not going to actually help you. Like you need to actually just build a better product. Instead of just kind of like that blank signaling there. But yeah, I do think like what Hyperliquid has done though with like the HIP-3 markets has been an interesting idea to kind of outsource your growth prospects to people that actually just want access to the users of the platform. So I think like right now there's like around 3 million hype staked across all of the HIP-3 like market providers. And so like there's always been like good like incentive alignment around the hype token itself. And I think that like outside of just like raw buybacks from revenue, it's like, okay, like, you want to launch like a HIP-3 market, you got to stake 500K hype. You want to own a ticker, you have to bid in like the like auction itself. And then all the money from the auction then goes back to buying back hype as well. Like they've been really clever around understanding like your token is your incentive, like mechanism essentially. And they're incentivizing people to grow the platform now. Like I think some of the larger products by open interest right now are some of those more kind of esoteric, not even esoteric. They're just like actual financial products, but like in perpetual like swap form. Like people getting perp, like S&P 500 perps. Like that's one of the larger products over on Hyperliquid now by open interest. So clearly there's demand for this. And then also you see like, Athena with Hyena, I think that's actually a really interesting idea where right now they have pretty basic products over there, but all the collateral is yield bearing in the form of USDE. And I think that's actually going to be the only way you can really scale a stablecoin from now going forward. Like I don't think like PayPal is going to find success with their stablecoin. I don't think a lot of these other providers are going to find success in like their individual stablecoins. The last stablecoin we saw that penetrated the 20% market threshold was BUSD, which is Binance USD. And the way you can incentivize the adoption of this is just like, lower maker taker fees. How can you have control over those fees is if you're actually on like a trading venue itself. And so like Athena's strategically realized, okay, like we have this cool yield bearing stablecoin. We've probably maxed out the raw supply we can get from people just wanting exposure to the basis trade. Now they're kind of going all in on, Hyena and then their stablecoin as a service, where all of it's going to be like yield bearing no matter what. On the most boring side of it, it's like backed by BUIDL, and the more exciting side of it, it's yield that comes from the basis trade. So I think like that's an interesting idea that Hyperliquid has had, of like, okay, like we have users, you want access to our users, stake 500K hype, you can launch markets, you got to do the front end yourself, you got to like bring the traders itself, but like you can have access to like hypercore infrastructure through this. So I think like that's a pretty interesting idea that they've done quite well on.
So you don't think that like a platform stablecoin that's kind of differentiated from like the trading activity necessarily has much sway here? Like Phantom has cash now, and I think the PayPal example is a good comparator as well.
I think they're going to spend so much money trying to get adoption on these things, and I think like a lot of people are farming the incentives on Camino because they're quite juicy. But like ultimately, when you think about like why is there so much Tether? Why is there so much USDC? It's like, well, there's so much Tether because there's just like USDT was the like denomination asset for the largest pairs across the largest exchange, Binance. It didn't get to where it's at because people were like, I really want to be able to like see P2P payments with Tether. It got there because like it just had the network effect of the largest exchange. And then same with USDC. Like the reason that's big is just because it was, largest base asset on Coinbase. And that's also, I think, why you generally see that like kind of east-west divide between like, USDC and USDT. But I think the last chance to break into the stablecoin market in any meaningful way is going to be through trading. And I think also like the native markets team, which won that like RFP process over on Hyperliquid to kind of be the canonical stablecoin. Those guys realized that as well. Like, this is how you're going to actually grow stablecoin at a low, like, without like being extremely like gluttonous with incentives and like actually trying to get like real users. Like people are not holding or using your stablecoin because they favor it in any sort of way. Like it's just going to be the like incentive. So now it's up to like Athena to actually bring really interesting markets over to their like HIP3 instance. But yeah, I would say that's one of like my higher conviction ideas around stablecoins.
Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axie Infinity. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at sablier.com. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
How do you think, maybe two questions here, like on the USDH and native markets idea, I think it's seemingly like they are still going to have a very hard time to draw like the collateral base away from USDC, which is the dominant, one on Hyperliquid today. I'm not sure quite how they do that, right? It's a fresh team. Like it's not like they have a big set of captured users that will just willingly go ahead and use USDH rather than USDC. And you spin up a bunch of sort of like copycat pairs in the alternative, quote asset, but it wouldn't make sense if, the liquidity on the USDC pair is so much better. So I guess how exactly do they go about this? What do you think is the strategy?
I think the simplest strategy is just like, how much yield have I missed out on from not having like a yield bearing asset as like the collateral? So like if you look at all of the USDC on Hyperliquid since its inception, it's missed out on, I think, like roughly $450 million of yield that could have just come from like T-bills. And so it's like, is this really going to continue? Like, why are we actually using USDC? It's like, yeah, like the liquidity is good. And like, I do think like that is probably the biggest hurdle for them to get over. But I think also when you look at like what Athena specifically is doing with trying to do this of like, you know, they're more or less like vampire attacking USDC, where it's like they're incentivizing deposits of USDC and then they're actually redeeming it for their own base asset. So like if you see what they're going to do with like Jupiter Lend, which is all public information, you can go like see the announcement. Like there's around like $750 million of USDC on Jupiter Lend. All of that's going to be converted into their own stablecoin for Jupiter itself, ran by Athena and backed by essentially like BUIDL on the back end. So BlackRock's, money market fund. And then from the Mega ETH like deposit contract, like I think that was another roughly like 500 million. So, you're taking like 1.5 billion of USDC and then automatically converting that right into like their own asset itself. So I think like there's going to be a lot of people that just see like, okay, you can actually just like, why am I forgoing my yield and like giving these stablecoin issuers, 100% net interest margin when I could actually be getting at least a slice of that myself. I think that's like the simplest strategy and the way to think about it. But I do think it's going to be generally hard to compete on the same markets. Like, is the BTC USDE market going to be competitive with like the BTC USDC market or the BTC USDT market? Like, it's going to be really tough to break into that. I think you're going to need to bring new products to market that have ample demand for them and are not offered by others. And I think that's ultimately how you're really going to scale that stablecoin supply.
Yeah, I think that makes sense to some degree. And I guess, we see in the TradFi world as well, like there is definitely interest as well to utilize stablecoins for similar purposes. Maybe it's just, simplified kind of operational purposes of giving someone a USD denominated asset and maybe some way of passing along the yield without it necessarily being like a treasury or like cash based product. Or maybe just makes it easier for them to kind of like get their toes wet into crypto. I'm not totally sure of the specific ideation at this point, but definitely a lot of teams are thinking along those lines. I guess we talked quite a bit about perps. I wanted to get maybe just your last thoughts on, we're seeing a new sort of like next gen of perps potentially coming here to Solana this upcoming in 2026. Phoenix, who previously ran the onchain collab, is now launching, or Ellipsis Labs, I guess, who previously ran Phoenix, the onchain collab, is now launching Phoenix Perps. And like the core innovation here has really just been prop AMMs, enhancing liquidity and making the trading microstructure on Sol much more interesting and make a lot more sense, really, to just trade assets on chain rather than on like centralized venues. And we've seen that definitely with the larger pairs. So like the Sol USD pair is doing more volume on Sol than on Binance and a lot of the other sexes today. So I guess the idea there would be that you can now potentially build a perp dex, kind of anchor that with prop AMMs behind the scenes to enhance the liquidity of that venue and make it like a more competitive offering compared to what we've traditionally had with perp dexes on Solana. Do you guys, do you have a strong feeling about this trend? Like, do you think this is actually an opportunity for Solana perp dexes to like become relevant within the scene? Because I think really the theme for the last kind of 2 years here has just been like not competitive. Jupe perps like is great and pretty big, but it's not really in the conversation with like a Hyperliquid or Binance perps, for example.
I think 2026 is likely going to be the most exciting year we've seen so far for like Solana perps. Obviously, like Phoenix, that's going to be really exciting. Let's see how that product actually does. I think it's kind of too early to call just based off like the idea of it alone. I think we have to wait and see if the users actually show up as well. Same goes for Bulk. Like Bulk is another like perps DEX that's going to be launching on Solana. And that's also going to make like the validator landscape a bit more competitive, where they have their own fork of Judo Agave as well. And then also you're going to have BAM, which allows for plugins, and plugins like Drift is going to be using that for, maker prioritization, which is something that was not optimized for previously. And then I think Jupiter can obviously do a similar thing as well. And as any perps DEX can really, like Phoenix could plug into BAM. We just have to see if the users show up, right? I think there's generally like a appetite for trading that we've seen from Hyperliquid users. We haven't seen replicated on any other chain yet, especially like on any SVM chain. Another one, of course, will be like Ambient on Fogo. So like there's a lot of perp dexes that are launching specifically in like the SVM world over the next year. I'm just really curious if like the user appetite is there. Yeah, that's. I think it's just kind of too early to call. Like, obviously, it's going to be exciting, but like, we have to just like see if the people show up and actually want to continue trading these assets, and why they're going to pick one platform over another. And yeah, we'll have to just wait and see. That's kind of my boring opinion on that. But I do think going into the next year, like one of the other exciting things is a lot of like kind of the RWA products we'll see, which are like. They're actually not exciting, they're actually really boring products, but like they're really like there's like true actual innovation happening over there. So I think stuff like that, like tokenized products, very simple ones like tokenized money markets, even all the way into like more kind of esoteric products that take the form of like a vault structure for stablecoin depositors to get into, and then anything done on the back end by issuers as well. I think like that's going to be a lot of like exciting stuff over there. But yeah, I think we have to wait and see if people have the appetite, because there's going to be not too much liquidity across like 5 or 6 venues at the same time. I would imagine. So like we're going to see like where that aggregates essentially, and I think a lot of that could also come down to the incentives, like how much are people paying in fees, how much are people being promised in like backdoor TVL deals or volume deals. Stuff like that. So like we'll have to wait and see. Kind of my take on that. But Teddy, I'm curious what you think.
Yeah, I don't know if I have anything worth adding too much on the perp landscape. Beyond what I've said, I think I echo kind of most of your sentiment, and then agreed on a lot of the tokenization products are interesting. I think like obviously Athena has taken a lot of the work Securitize has done and made that interesting and immediately like valuable to teams that want some form of interest bearing stablecoin, interest accruing stablecoin, however you want to put it. So I think that's interesting. And then yeah, Ian and I have been working with another couple of teams that would like to bring kind of like tokenized products on chain. So I think there's a lot of exploration going on there. And it's pretty exciting to us. Like I think there are these markets that have historically been very illiquid, not very easy to get access to. And then if you can't get access to them, you can't really get any form of risk management products around it unless you own billions of dollars worth of it. So we're interested in kind of that combination happening on chain, and people can build risk management. Like you can use Pendle, you can use Euler, and a number of these products like make it very interesting immediately to have on chain. So we're excited about that.
Yeah, I think those are great points. And I know at least on the Solana side, Camino made a bunch of new product announcements recently. A couple of those really interesting, fixed rate, fixed term lending opportunities, borrow intents. Another one like using off-chain collateral for on-chain loans. That seems quite interesting as well. And trying to do like some private credit, bring some private credit products on chain as well. So yeah, definitely seeing a lot of people leaning into just traditional finance products being brought on chain, and then kind of opening up the ways to access those, make it easier to actually make use of that product that is on chain, because maybe it, for a long time, it's probably been difficult to get, meaningful capital on chain for certain types of funds or vehicles, et cetera. Either regulations, rules, restrictions, or other kind of like limitations there that have prohibited them in the past. And maybe on the perp side, like for Solana, I guess as we've seen like meme coin activity kind of cool down a bit, yet there's still like a pretty significant amount of just like raw kind of like spot trading activity. Maybe that is sort of like the open door for some interest in perps activity. Assuming, if the platforms offer competitive sort of liquidity and spreads, then you could see some of that attention maybe shift away from some of the raw meme trading to let's go 10x long, BTC or whatever. Just a different form of speculation potentially.
Yeah, I think another thing that I'm generally curious about is like, obviously like you're saying like there's like a lot of like spot volume, like, Sol USDC. I'm just kind of confused on like, I don't think that's like orders originating of like, I want to swap between Sol and USDC. I think like a lot of that, especially why like Humidify is able to do so much volume, is because like that's just like the base asset for every single pair on the chain. So if you're swapping some random XYZ token through Jupiter or any other like aggregator, like it's likely one of those steps is probably hitting like a Sol USDC pool. I think like to my understanding, like that's why like a lot of that volume even actually exists. Like I don't think it's like raw demand of like people really want to like trade like the spot movement of Solana on chain. And I would like push back if I'm wrong on there. I'm sure there's someone listening who thinks I'm wrong or knows I'm wrong. But like that's kind of another thing that I've just been thinking about more so with like the prop AMMs of like, it's not really indicative of real demand on chain. It's like, yeah, like the prices are like the quotes are tighter, but it's also like the quotes are quite small. Like the sub 10K is where they're most competitive. And then obviously like that changes, but that's just like something like that's like my one like kind of criticism of these things. And I haven't really seen too many people criticize prop AMMs, like a lot of glazing on them. So kind of like one pushback there of like, are we seeing real adoption there, or is this like actually indicative of other just general activity on the chain, which is like good at the same time? Like no matter what, it means like people that are swapping are getting better price execution, but like also like maybe we should maybe it's not true that there's actually like on-chain demand for people that want to trade like spot Sol.
Yeah, I think I'll push back a little bit in that it's I'll agree and I'll push back, if that makes sense. I'll agree in the sense that it may not necessarily indicate that you have retail guys trading $100 of Sol. I think what it does at the very least indicate is that spot arbitrage that was happening maybe sex to sex or sex to dex is just happening directly on Solana instead of maybe happening on Binance or Bybit or between those venues, for example. But I guess why I think that is still interesting is that if on-chain Sol spot is the better place to trade the asset, then you're at the very least like offering it up as a better platform for those retail traders to come in and trade the asset. So whether or not, like I would agree with you, it would be hard to say like that growth in volume, maybe or maybe not the retail trading volume has increased or not. It's hard to say. If just more of the ARB volume has come on chain, then you can't really tell. But at the very least, it sort of presents, I think we mentioned earlier, like sort of like that Robinhood style opportunity where you're getting a better quote on the asset you want to buy. So if you're not here today, it's becoming a better place for you to at least go there in the future. So we'll have to see. I agree with you. Like the perps thing, that's wide open. I mean, first we need to see the products before we see anything. But if you can see a similar sort of dynamic where they can have really good pricing, then, and of course incentives because they'll all be pre-token. So, the farmers will come out, I'm sure, for some of these, at least in some degree of size. But just that pricing and then liquidity aspect, I think is interesting for, a retail guy if you want to get quoted at 9 bips instead of 90 bips type of thing.
Yeah. I think also like retail is largely fee insensitive. Like I don't think they care. And another thing is like people say like price discovery is now happening for Solana on chain, which is not entirely true because like there's far more volume on USDT pairs specifically the Binance one, and also like the FD USD pair as well. Like are both doing more volume than the Sol USDC pair. So just my pushback to get attacked by people, but yeah.
I love it. But awesome, Ian, Teddy, it was great having you guys on. Great to chat. We'll have to do this more often. I'll have to get, it was great to hear your takes on the validator scene and kind of the broader space. So always a pleasure. Until next time, I'll let you guys get into holiday mode.
Yeah, let's schedule something for Easter, perhaps.
Okay. Yeah, we'll get the next holiday queued up, I guess.
Thank you, again.
Yeah,
All right.
Thank you.
Thanks, guys.